Hello, everybody. My name is Stephen Mead. This is Domicile real estate for people who love houses, and this is our Southern California housing market update for August 24th, or should I say through August 24th, 2020. And this week we kind of have something special for you. This is a question that I have been getting from several people. They want to talk about both in comments, people emailing me, and then sort of people that I run into in person. They want to know about this. So I thought I would dig a little bit of research and talk about forbearances for a minute and sort of talk about what we think defaults and forbearances might mean for our market here in Southern California. So before I do that, though, I need everyone to understand that this information is based on sort of my opinion of the Southern California market, how it might affect things. And for our purposes, we're calling that Los Angeles and Orange counties. And the reason why I put this little cautionary note in here is because there's a lot of factors that sort of go into how markets move, and they don't always move at the same time. So it's important that if you're not in Orange or Los Angeles County, that you understand your results may be different with that. So without further ado, I've kind of got some extra graphs and some things this week that I thought I would bring up. The first one is my favorite graph, and this is the scary one, right? If we take a look at this, what this graph is showing is it is showing mortgage delinquency rates. And if you look down here in the bottom, this is from 2006, quarter by quarter, all the way through Q2 2020. So this is basically data that is true as of June, the end of June 2020. And if you look at the very bottom here, we actually have these are kind of, they divide this up by sort of the length of the delinquency, whether it's 30 to 59 days delinquent, 60 to 89, or 90 days plus, which is the green number. And if you take a look here, you see this should be pretty obvious to most people. This is the financial crisis in here where we peaked at 10.06% of all mortgages were in some level of default, right? And then if we see things kind of track down as the economy recovered. And we had quarter one, things were still pretty good, around 4%. By the way, that number between 4 and 5%, that's pretty constant for what a normal rate of delinquency is for mortgages, for including all types of mortgages, conventional, jumbos, VA, FHA, kind of throwing all those in. If we look at quarter two, though, look what happens. We jump. And when I say jump, I mean, this is really a leap, right? Quarter to quarter, 8.22%. And if you are looking at this graph, this looks pretty ominous, right? I mean, this basically says the country is failing. People are going to be defaulting, and I'm going to see foreclosure signs in my neighborhood all over the place. Well, hold up a minute there for a couple reasons. Number one, something that is not on this graph, that is in the text that was below it and that is rarely mentioned, this graph includes loans and forbearance. So let me repeat that. This graph includes loans that are currently in forbearance. So if you sort of take that into effect, right, this number looks a lot less scary. This isn't necessarily people where they're on the verge of being foreclosed upon, which is sort of normally how we think of graphs like these. So that's the number one thing to understand is while the default data looks scary, it doesn't really tell the whole story. Moving on, we've been hearing a lot about forbearances, and I thought this graph was kind of interesting, right? Because if we look at this, back in March, we had 0.25% of loans in forbearance. By June, this had just run up, and we got to 8.55% of loans were in some form of forbearance. And basically, this is from the Mortgage Bankers Association, so it actually only shows 75% of the mortgages. So it doesn't show the complete market, but this is a pretty good approximate snapshot, right? But I think what's important here is noticing this trend. And I'm gonna go off share here for a second and mention something important about forbearances. So there are two really important things to understand about forbearances. So if you don't understand anything else about forbearances, there are two things to understand. Number one, this time around, in order to get a forbearance, with most loan servicers, you really didn't have to do very much. All you had to do was call up your servicer and say, I'm having trouble. So, and it also didn't negatively affect your credit score in most cases. So, and it didn't involve permanent credit changes, right? Like they weren't reported as late. And I think because of that, I think there were a lot of people in March, April, May who basically decided to go into a forbearance program sort of as a hedge, right? Sort of as an emergency, just in case, right? Like kind of like bringing an umbrella with you when it's cloudy. And so I think that's the first thing you need to understand about forbearances. The second thing you need to understand about forbearances is that you cannot refinance your loan if it is currently in forbearance. And that actually does a lot to explain why that rate in forbearances is dropping. So, if we go back in here and we look at these percentages, right? So, and I'm going to go to the next chart to just kind of complete my story here. This is actually from just about a week ago. Fannie Mae and Freddie Mac forbearance rate drops below 5% and is the lowest rate since mid-April. And I think what's important to understand here is if we think about all the loans in forbearance, and that's a combination of people who legitimately are having trouble making their payments, right? As well as people who, shall we say, are doing a forbearance for precautionary purposes. I think a lot of people were scared during that time frame. We don't know that ratio. So that number may not necessarily mean everybody who was having a problem paying their mortgage. And the fact that that rate for Fannie and Freddie is now below 5%, I think indicates that now that interest rates are low and there's actually a cost to being in forbearance, and that cost is you can't refinance your loan, a lot of people are leaving these forbearance programs. Also, employment is coming back online. Unemployment rates are dropping. One of the things that we also do have to talk about, and because I think a lot of people in the real estate business like to put on some rose-colored glasses, the reality is we do have heightened unemployment. There will be some people who are unable to make their mortgage, and they're going to have to do something because they can no longer afford that house that they're in, right? And I think that's undeniable. So, there is something coming, right? In our market, that is to say, Los Angeles and Orange counties, I don't think that that's a huge factor, and there's a couple reasons why I don't think it will end up being a very big factor. Reason number one, I don't think it's a very big factor for us, is that among those people who are finding themselves in a higher unemployment and a lot of difficulty, because our houses are so expensive, a lot of these sectors that are hardest hit, hospitality, restaurant, retail, these are not our typical homeowners in Southern California. So, that's going to disproportionately affect the rental side of things. And I don't have a graph for it, but guess what? Rental vacancies are way up in Los Angeles and Orange County. So in fact, that is exactly what's happening. Whereas, there's a run on buying houses. The second reason why I don't think it's going to be a very big factor for our market is that the percentage of equity that people have in their houses has grown significantly, over the last 5 years or so. Meaning that, if you run into trouble, right? If you enter a forbearance program, your unemployment, you've either lost unemployment or unable to get unemployment at the same rate, and it sort of becomes clear you're just not going to be able to afford this house anymore. This house is not going to go to short sale. It's not going to go to foreclosure. You're going to call your realtor, hopefully me, and we're going to put a sign in the front yard, and it's going to be a market rate sale, right? We're going to control the timing of that sale. You're going to get equity out from that sale. It's not going to be a distressed sale in the traditional sense. And the third reason why I don't think it's going to be a big factor is we are so inventory constrained at the moment that even if another 10% of houses were to show up, I don't think it would make a huge difference. So that's kind of my thoughts on forbearances. Do we have a looming crisis? As of right now, I don't see that happening. Again, we keep watching these things because things are subject to change. Let's go ahead and jump into sort of our normal roundup on our stats this week. If we look at our new listings, we've really plateaued out here. It's just not, that rate of growth just isn't happening. And again, I apologize. Google Sheets seems to love using light colors because I've run out of all the bright colors. We're just not seeing it under million category. And in fact, in the 1 to 2 million, our rate of new listings is faltering. It's actually receding and dropping. So, we're not seeing this groundswell of listings coming into our marketplace. If we look versus last year, yeah, we do have a little bit more than last year, but not really. In a hot market, you would expect tons of sellers to be putting their house in the market, and versus last year, and it's just not happening that way. This is 28 different, or basically, oh gosh, like 1.5% better than last year. I mean, that's negligible enough to say it's the same. Now, if we look at new escrows, that has also plateaued out. And, I think what I'm going to repeat is, I think what's happening is we are seeing extreme supply constraints, and, we're really limiting the sort of ability to sell houses. I feel like if we had another 500 houses come onto the market, we'd sell another 400 houses. I'm seeing this isn't a sign of a market that is petering out on demand, because guess what? Every house has 10 offers on it. That's not the problem, especially the desirable houses, right? The top 20% of listings will get 80% of the activity. It has always been that way in real estate. If we look at our 1 to 2 million, that's actually grown a little bit more steadily. It'll be interesting to see what happens to prices in this category, because if those new listings don't show up, there's really nowhere to go but upward on the prices. And if we're comparing this to last year, right? Guess what? We're only up 1.5% on listings, but we're up an even bigger percentage on new escrows. I think we're just bouncing on a ceiling here. Among the homes that come onto the market, there's a certain percentage that will never sell. We know this. So if we go back 2 graphs here, hold on. If we've got 1,938 new houses coming on the market, and nearly 1,600 of them are going into escrow, I mean, we are pretty much bouncing on that ceiling. All of the sort of viable new listings are getting soaked up into the market. We are very much inventory constrained. And if we look at our absorption rate, kind of 2 interesting things are happening. One is that, we just keep oscillating right between this 80%-ish and high 80s. We had another week at like 81% absorption rate in our under 1 million. But look what happened over here in 1 to 2 million. Boy, a lot of people suddenly have confidence about buying in that $1 to $2 million range, and the number of listings is not going up to match that increased demand. I'm curious to see if this is just a one-time 1-week spike, or if this is something that we see continue as a trend for a couple of weeks. If we go back and look at our average pending list price, again, this statistic is the average list price of the homes that went under contract in the last week. If we draw a nice little graph here, we see some anomalies, some spikes and things, but I think it's pretty firmly in this upward direction. This is where prices are heading. If we see a lot of weakness in the market, we'll see it show up here before it shows up in closed sale weakness. So kind of keep an eye on this space, but as of right now, we're still supply constrained, prices are going up. If we look at our list to close ratio, right? So this, I think I went through this explanation last week, but it's really important to understand what this graph is and what it isn't. And what this graph is this is telling us, how does the optimism of sellers compare with the reality of buyers? So whenever you see this number over 100%, what that means is it means that the optimism of buyers is exceeding the optimism of sellers. And it means that buyers, in the mind of buyers, prices are moving up faster than they are in the minds of sellers. And, another interesting statistic and thing to talk about with this is, if you were a buyer and you came to me today and you said, what should my strategy be? Should I offer list price or should I offer less? My answer is going to be neither. you need to offer list price, or you need to offer over list price. Like, you need to be above, because the average sale, meaning on average, we're hitting above the list price. So just to, we have the number on here that's a percentage, but what I'd like to do is kind of tell you what the numbers are behind. Our average list price was $635 and change, and it was $638 for our close. So that means that on average, of the houses that closed in the past week under $1 million, people paid $3,000 over list price for that. This is really huge to just sort of understand what that means in our marketplace, and what it means if you're a buyer going out in that marketplace. You kind of have to get beyond that psychological don't pay over list price mentality, because if it's a popular house, you will be paying over list price, statistically speaking. If we look at our average pending list price for our $1 to $2 million, guess what? It went up last week, and it's actually 1,392, I think, is where it's at. And if you look back on this graph to when we started tracking back in the middle of May, I mean, yeah, we've had some steady increases in that price. We don't have as much data, so these tend to bounce around a lot more, but you can definitely see a trend line moving upward over the last 2 months. Days on market for our new escrows. And, this really is this is sort of the ultimate, how healthy is your market and how strong is demand? Like how crazy of a market is this? And, guess what? We had another week where our days on market average for under $1 million listings was 26 days. I mean, it's just that anytime you're below 30, you're talking about sort of a superheated market. That's just the reality. Now, if we look at our $1 to $2 million category, and again, I apologize, it's kind of faint here. If you look at this, we're at 40 days, right? This is sort of nuts for properties in this price range, that you are under 40 days on market. Maybe I'll bring in a chart and show you what it was like 5 years ago, just to give people sort of a reference point. But I mean, gosh, you got to look at this and understand these are sort of extraordinary figures. And finally, too, before we get onto our affordability graph, I want to kind of speak out to our first-time home buyers that are watching this. I know there are more than just a few of you. Later on this week, we will be launching sort of a specific market stats. It'll be a shorter video than this. Market stats and affordability update for first-time home buyers. We might include a little bit more anecdotal, like one of the ideas we have is to kind of showcase what is the second or third cheapest single family in a particular city every week. So you can just kind of get an idea of what do you get for, what is that number, what do you get? So we're going to try to incorporate a little bit more contextual stuff in there to kind of help first-time home buyers who are kind of trying to figure out their strategy, maybe get a little bit more clarity on what the right direction is for them to go. But without further ado, I'm going to bring up our chart here for our affordability analysis that we have been running. So here we are. And just as a reminder, what this graph is showing you is we set June of 2018 as a baseline for the median priced home in Orange County, which is single family and condos. And if we said that's our baseline of 100%, what has happened to the payment on that median priced home as time has gone on? And we've actually seen a steady drop. The reality is, folks, homes are actually getting more affordable, not less affordable. And we had kind of a weird spike last week, and that was driven by a median price increase. But this week, we've kind of gone right back down to about 90.4%. So, basically, since the pandemic started, we've just been kind of hovering in this zone. And as I mentioned a couple times before, when people ask me, can prices go up, right? Is there room for prices to go up? My answer is absolutely, because look at all this space we have, and that's just to get us back to where we were 2 years ago, and people were buying houses. So kind of when you think about it in that context, we still do have a lot of room to grow in prices. Obviously, watch this space for interest rates. I know I am personally in the minority on this. I am not so sure that rates are going to remain low for years to come, which is kind of the general message people are getting out there. I kind of think all bets are off after the election. So I think things will look like they do now for the next few months. After that, I think we're just gonna have to watch and wait and see. As usual, we love your questions, comments. If you have a real estate problem we can help you with, especially if you are in Los Angeles or Orange counties, we would love to help you with that. Definitely reach out, and we will see you next week.